This is the CRE Weekly Digest by LightBox, a data and technology firm for the commercial real estate market. I'm Martha Kocher with Manus Clancy, Head of Data Strategy, and Diane Crocker, Research Director. For the week of July 15th through the 19th, big banks reported earnings offering some takeaways for commercial real estate participants. And economic news included June data for retail sales that were flat and housing data that saw a big increase in housing starts in multifamily, but a drop in home builder confidence. Still, investors did seem focused on the rising odds of a Trump presidency. And Manus, we did see treasuries and stocks move as investors digested the policy implications of the November election outcome.
Crazy week, I guess, is what we would say. Last week was all about economic news. When we got on our podcast, it was about CPI and PPI and unemployment. And this week normally would be focus on big bank earnings. They were parsed, and we'll get into that a little bit more, for their CRE exposure, people looking for clues as to how big the CRE problem will be for the SIFI banks. But between what happened in Pennsylvania on Saturday and the current president having COVID, it seemed like all eyes were on what's happening in Washington, what's happening with the election. And to your point, everybody began to retake stock of what might happen in November. And I think that it's hard to come to grips with that. We do know what the Biden presidency has brought us. We do know what a Trump presidency brought us 4 years ago. But I do think that this gets very tricky when you start trying to project what they might do over the next 4 years and try to use that insight or that wisdom to figure out in real time what that means for stocks and bonds and commercial real estate. So a very strange week. And I guess more to come. We're going to talk about the Biden rent control proposal shortly. By and large, I would say that it was an okay week for CRE. We continue to see big transactions of 9 figures and higher. We saw a couple of billion-dollar transactions this week, which was great. Treasury yields flipped. They're near their recent low at about 4.18% for the 10-year, which anytime the 10-year continues to grind lower is a good thing. And people are starting to talk about a high likelihood of a September rate cut, which would be good for those that use floating rate debt. So all in, a modestly positive week for CRE, an uneventful week for the markets in general, and a very eventful week for the political scene.
Let's shift into bank earnings. You mentioned the bank earnings and parsing through those. We saw big banks report earnings. The big six primarily provided us some insight into what is happening in commercial real estate and gave us a view into the outlook for the remainder of the year.
Yes, several banks reported between last Friday and early this week. On the positive side, we saw some real surprises, I would say. We did see that Bank of America and JP Morgan, I believe, both noted that revenue from deal making was up. Deal making being IPOs, bond issuance, things like that. That took me a little bit by surprise. I still think that we're a little bit stuck in the mud when it comes to IPOs and deal making. We do know that CMBS issuance is way up, but that's such a small part of the market that you wouldn't think that that would move the needle. But the fact that 2 of the banks said that deal making was up, I think is a positive sign. It is of a piece to our narrative from the last couple of weeks that things are happening. And we've said things are happening in the CRE market. And to me, this was evidence from these banks that things were happening beyond the CRE market, that IPOs and deal making and trading revenue being up shows that people are transacting. And overall, I think that that's a positive. Another positive was that nobody really sold off in any material way after their announcements. Yes, some of the banks were off modestly, but nobody said we are running into enormous headwinds on commercial real estate and things are far worse than anybody thinks. I think that the fact that banks did not come out in panic mode was also a positive sign, but they were also cautious. They do know that we're far from out of the woods on CRE, that offices remain problematic, and there will be bumps in the road. And I think that that's about right. That is the negative, that we are far from the end of this cycle. There'll be more negative headlines, probably more reserving that has to take place. An uptick in non-performing loans is probably on the horizon. But by and large, I would say that the bank earnings didn't do anything to rattle people at this point. Diane, what are your thoughts?
I would agree, Manus, and I don't think anybody wants to be rattled at this point after some of the political highlights that you just covered at the start of this podcast.
I'll say first that I think what jumped out at me from the bank earnings report was, first of all, Wells Fargo CEO's use of the adjective lumpy, which I thought was interesting, that they expect losses driven by office properties to remain lumpy, and that gets to your point that there's an expectation, that we're in the early phases of this. And I think, here at Lightbox, we're already seeing and hearing evidence of those loan sales that you talked about increasing. And to a point you made in an earlier podcast, Manus, the reassuring aspect of that is that buyers are lining up to buy these loans from bank portfolios. So as banks start to de-risk and face pressure to do so, there'll be willing buyers ready to line up. So I expect we'll see that trend continue.
We now have two banks that are on the record for multiple rate cuts over the next 18 months. I think last week we talked about Citibank.
Yeah.
I don't know, was it 6 or 8 cuts, I think, over the next 18 months was their call. Bank of America this week thought there would be 5 cuts, which is a mixed bag. Yes, 5 cuts would be great, especially for all those CRE, CLO borrowers that loaded up on floating rate debt and are hanging on by their fingernails to avoid losing their properties, especially in the multifamily segment. That would be wonderful for them. But if Bank of America and Citi are thinking there'd be that many cuts, you have to think that they're believing that we will see a bumpy, hard landing. You're not calling for that many rate cuts unless you think that there's more bad news for the U.S. economy coming down the road. And so kind of a mixed bag with that. I want to detour for a minute. This is something I put together over the last 24 hours, which I thought was really important to do. And by put together, I should be very cautious with my words. I lean heavily on a gentleman that I worked with for more than 10 years, a guy named Matt Anderson. He's an economist out in California, in the Bay Area, really knows his stuff. He's my bank whisperer. So I had been seeing a lot of things on LinkedIn and on Twitter about non-performing loans for the SIFI banks, and people noting that Wells Fargo, for example, that their percentage of non-performing loans was up more than 10% this quarter. Now, we all know statistics can be crazy, right? If there was, one car theft in Miami in the first quarter and there were 2 in the second quarter, that's an increase of 100%, right? But it's only an increase of 1. And what we saw with Wells Fargo was an increase from 2.6% last quarter to about 3% this quarter. So Twitter and LinkedIn were coming up with, wow, that's a 10 or 12% or 15% increase quarter over quarter. The world is falling and so forth. So I said, how does this compare to after the great financial crisis? I want to put this in perspective. So Q2, after this week, based on SEC filings, non-performing loans from JP Morgan, 0.6%, up from 0.5% last quarter. Bank of America, 2.8%, actually slightly down. Wells Fargo, 3%, as I mentioned. Citibank, 0.4%. So on average, let's call that about 1.5% for those 4 banks. And by the way, this is not a perfect thing. For JP Morgan, they include when they report both CRE and C&I loans, so it's a little bit noisy. For Citigroup, they talk about all corporate loans. So again, it's not a pure reading. But Matt went back for me, and he pulled the data from right after the great financial crisis and listened to these peaks. JP Morgan peaked at 4.8% in 2010, so 8 times higher than where they are today. Bank of America peaked at 10.8% in Q3 2010, Wells Fargo 6.6% Q3 2010, and Citigroup 15.3% in Q3 2010. So Q3 2010 was almost exactly 2 years after Lehman failed. So 2 years after Lehman failed, they were talking about, in some cases, double-digit non-performing loan ratios. We are now 2 years past peak CPI and 1 year past the most recent Fed rate hike. So this should give people some kind of measure of comparison between 2 different crises. And I think that people who are out there believing that we are in the great financial crisis, this tempers that opinion just a little bit. Certainly, if we see next quarter, Wells Fargo 4% and then 5% and then 6%, yes, it's time to panic at that point. But right now, it seems like banks have done a pretty good job of managing this risk. And I think this was really encouraging. This was a terrific analysis, and I think it offsets some of the doom and gloom that's coming out of social media right now about banks.
So, Manus, just to give folks some reference, when you're speaking of SIFI, it's an acronym for institutions that are systematically important financial institutions, or essentially what people use in the vernacular is too big to fail.
I should have defined that first. And if I didn't define NPL, that's non-performing loan. So these are two important measures to keep an eye on. When you find yourself panicking, it's important to bring up these measures for a point of comparison to maybe restabilize. Because if you just follow what's on Twitter, you will think the world is ending right now.
In the outlook for many of the banks, they mentioned a lot of risk that they can't really put a number on, and that's geopolitical risk and some of the other regulatory risks. Additionally, they talked about, in many cases, the fact that interest rates are probably at their peak right now, and so their net interest income probably will take a hit over the course of the next year as that becomes something that the Fed puts some attention on reducing rates. Any thoughts on that?
I guess my thought at this point about this is maybe a little bit going far afield of your question, is that even though longer interest rates have been up and short interest rates, both, right, over the last 2 years, and it's given banks the ability to arbitrage the difference between their loan rates and their deposit rates, it hasn't been easy. We're dealing with an inverted yield curve. We've been dealing with the threat of deposit runs. We saw that happen with Silicon Valley Bank. And I guess my takeaway would be, I'm a little bit surprised that in the last 16 months, we didn't see more bank failures than we did just because of the deposit run issue. And the fact that that's the case and that banks haven't had more problems given the rate volatility, given the CRE issues, makes me believe that they can handle anything, right? If their margins compress, if their net interest income compresses, it's not going to matter. They've shown themselves to be pretty nimble, pretty resilient. And I'm optimistic that our banking system, yes, maybe we'll see another 10 banks fail, but this is not a case where we're going to see 100 banks fail. People that are telling you that, I think, are tilting way too negative at this point.
So 3 things that we were watching. We're going to start with something you mentioned at the beginning of the podcast, Biden's forthcoming rent control idea. It's gotten a lot of ink in many of the CRE publications and on the media. In fact, they were just covering it in CNBC this morning. So, Manus, a lot of heat on this one.
Yeah, it's incredible, I have to say. It's almost like no bad idea ever dies. No bad idea that is started locally never can be stopped from being tried nationally, it seems. And to kind of drive that point home, I'll read a quote from the Wall Street Journal editorial the day after. It's hard to think of a worse idea than imposing rent control nationwide through the tax code. I think that speaks for itself, right? It was a bad idea in New York. It kept inventory down, inventory being lower for the last, 70 years, has kept rents high. People who are lucky enough to win the rent control lottery never give their apartments up. Owners of those properties, because the income is capped, never invest in those properties. So the physical plant continues to spiral lower. And now we're talking about trying it on a national level. Do I think that Biden can get this through? No. I think there's so much resistance to it. It's such a bad idea. But like I said, bad ideas have a way of rearing their ugly head over and over and over again.
So let's shift into a story that has probably got a lot of different tentacles out there. We've seen a number of stories about bonds backed by CRE debt that are seeing losses, and we're seeing analysis come out that is highlighting that. And analysts are saying there's probably more to come.
I think that's right. This is our second item on the big 3. This was a boatload this week of headlines about negative CMBS debt. Some of them coming in. This first one from Commercial Observer's Emily Landis. The Zampatini family fell into default on a $120 million loan in Mountain View in California. This is an office and industrial park. Maximus Real Estate is in default on a nearly $2 billion loan portfolio on San Francisco apartments. That's also Emily Landis. In Los Angeles, 333 South Hope Street, that's the Bank of America Plaza. That property is now potentially going back to the lender. That's in special servicing. News there by Sam Lounsbury and Kerry Hamanaka. Those types of stories were plentiful this week. They'll continue to be plentiful going forward. They will be most plentiful in markets where there's long commutes, poor quality of life, and for which property has big debt that's maturing soon. And that's the offset to some of the positive comments that I made in the open and over the last couple of weeks, is that people will have to balance my type of optimism and some of the statistics we have, which against a drumbeat of negative stories that talk about falling values, losses of properties by landlords. We saw another property in Chicago, the Palmer Hilton Hotel, for which the AAA bonds were downgraded 6 or 7 notches from AAA down to, I think it was single B. So those stories will continue to test intrepid investors' resolve over the next 6 months, because it's hard to put money to work when so much negativity is swirling around and it's not going anywhere.
Yeah, I agree, Manus. As I looked at the news from this week, it occurred to me that last year, everybody was expecting distress to hit. There was a lot of news about the wave of distress and the loans coming due in 2013, and we didn't really hear that much about it. And a lot of us were saying, look, this, it takes time to unravel. It's early. And so these stories that you just referenced are signs that, yes, it's starting to unravel. Who knew when the bonds were issued that we were going to face a global health crisis, or that we weren't all going to be going back to work in buildings 5 days a week for years afterwards, or that interest rates would get hiked to the historic highs where we find ourselves now. And, I think the day of reckoning is starting, and folks expected it to surface sooner, but it's here, and we're in the beginning stages. And one more thing, in the Wall Street Journal article that I thought was interesting, and to your point, is 90% of that article was gloom. And yes, it's real. And yes, it's sobering. And yes, there will be losses. But at the very end of the story was the flip side, that there are willing buyers, and they're circling and they're hunting for bargains. Companies like Beach Point and TCW and Ellington were a few that they mentioned. So I think we need to get used to these headlines, because the unraveling is definitely underway.
Yeah, our last story in this second of the big two was that Marathon was the other side of the coin. They joined Goldman and Blackstone as the latest firm to raise money to put to work buying distressed assets. So I'm not sure who wrote this. It was Bloomberg or somebody here at LightBox, but they called Marathon the latest shark to start circling the distressed assets. And so there are people out there looking to deploy capital, and that's a good thing.
Yeah, I thought it was interesting that John Brady from Oak Tree Capital wrote in a recent note to investors that we are on the precipice of one of the most significant real estate distressed investment cycles of the last 40 years, which is quite a statement.
It is. I mean, if you're saying 40 years, you're saying that includes the 1990s cycle, and it includes the great financial crisis. So maybe Mr. Brady and I will bet a beer on how this turns out 5 years hence, and look back on who was right. Obviously, he thinks it's the worst cycle in 4 decades. I think we're going to come out of this bruised but not battered.
Diane, we're going to shift into our third thing that we're watching this week, and that is the CRE Property Listing Index that LightBox produces. And it looks in detail at what's happening in the marketplace in terms of number of listings, activity, and it does feed into our overall CRE Activity Index. So what does that look like?
Yeah, so I talked last week on the podcast about the aggregate CRE Activity Index. And as you just said, Martha, this week I'm drilling deeper into our property listings data. So the index specific to that segment showed a 14% increase to 113.8 in the second quarter. And that's compared to 99.8 in Q1 and 110.4 a year ago. So that heads to a lot of the optimism that we've been talking about on the podcast. In terms of percentages, property listings were up in the second quarter by 14% and relative to the first quarter, and then a more modest 3% over where we were last year. But I think, it speaks to a lot of the points that you and Manus and I have been making. Sellers are definitely demonstrating a greater willingness to put assets on the selling block. So that's certainly, I think, encouraging for the market, especially given how slow 2023 was. Secondly, the other thing that we look at as a sign of what's happening in the trenches is how is the average number of non-disclosure agreements per listing changing? And that really kind of gives us a look into what's the level of interest by investors. How is the pool of potential buyers changing in terms of their requests to access things like due diligence materials and offering memorandums. So the average number of non-disclosure agreements, or NDAs, rose to 105 in Q2 across all geographies, across all asset classes. And that 105 average brought it in line with where we were last year. I expect that number to grow in the second half as the market gets more active, and we might get closer to 118, 120, which is what we have seen in peak years in the past. Now, Manus, I know you were digging a little deeper into office NDAs in particular, so what are you seeing over there?
I think it's consistent with what you're seeing. There's a lot of promise there. There's a lot of interest, and it does go to the narrative of what we were saying before with Marathon Blackstone and Goldman raising money for things. The number of people that are doing due diligence on properties, filling out confidentiality agreements, NDAs, and so forth is pretty elevated. It's the number of people that were circling office properties, by filling out NDAs in 2022 hit a trough of about 46 or 48 potential buyers looking at these properties. Since then, it's been kind of ticking up. It was in the mid 60s for most of 2023, and now we're in the high 60s, low 70s for the last 3 quarters. Over the last year, we've averaged about 67 non-disclosure agreements per office listing, which is a lot of people kicking the tires. That's up from a trough of 46 in Q1 and Q2 in 2022. So I think that's a bullish sign that people are looking at these properties and thinking about whether or not it's time to invest. So good stuff there.
Yeah, and definitely something that we'll keep watching. And then in terms of asset class, retail accounted for 19% of property listings in the second quarter. And in terms of pricing class, we saw some interesting things that the listings priced below 20 million accounted for 57% of the overall volume in the second quarter. And I think, that's really a sign that private equity is moving into play, searching for those smaller deals rather than the really large ones. And multifamily and retail accounted for about half of those listings below 20 million. One other thing, Martha, is I've spent a fair amount of time over the past week talking to leaders on the environmental due diligence front who are on our new advisory council. And I just wanted to share a couple things from my conversations with them. So this is intel from what I kind of view as the tip of the sword. These are firms who are out there doing environmental due diligence on deals with big institutional investors and private capital. I did ask them how they would characterize the market in terms of a scale of 1 being horrible and 100 to be improving. And the average across the dozen in the council came in about 70. I think that would have been a lot lower last year. So I think that's yet more evidence that the saw is on in these steamy summer months. And in terms of interest rates, I think flat is the new good, it seems. One council member said, no more rate increases seems to be giving our clients more confidence to do deals. So I think this was the quarter where big investors really came to terms with the reality that rates are locked for now, and they're starting to factor that into the decision and look around for opportunities as that window opens, rather than waiting for interest rates to drop, which I think characterized a lot of the first quarter. And then last, in terms of the forecast, most of the folks I talked to are expecting moderately higher volume in the second quarter. So that they're fairly optimistic, or cautiously optimistic, I guess is the right way to say it. A lot of mentions of the expectation of higher refi work, certainly hope for a first rate cut, providing kind of a psychological boost to the market. And I feel like we're there, certainly with the September Fed meeting. And I think, many are expecting to be doing more work with special servicers and loan workout groups as the day of reckoning I mentioned earlier is here, and the market's being forced to deal with those maturing loans. So all of that feedback is going to be in our market snapshot series of reports, which are coming out next week. So that's my shameless plug for those, Martha.
Okay, Manus, let's go through a little bit of a speed round of who's developing and then who's buying and selling.
Yes, it was a pretty good week for what's going on. Some real votes of confidence, as I like to call them, for the market. The first one in short order, the real deal's Susanna Cavanaugh. I had this story. RXR, which is Scott Reckler's firm, is eyeing conversion from office to multifamily of the Helmsley building. This is 230 Park Avenue. The property has a lot of debt. It's now with a special servicer. Why did this catch my eye? It's because not too long ago, Reckler was famous for saying that 90% of all New York office was now obsolete, and most of them were rotary phones living in an iPhone world. And now he's talking about kind of putting his money where his mouth is, converting one of these older buildings, although in a great location, into residential. So we'll see how that plays out. Steve Cuozzo, again, a second time, in the Lower West Side of Manhattan, Atlas Capital Group has secured a $1 billion loan to go forward on a Manhattan residential towers project. This loan is considered to be the largest loan for construction since COVID began. The lenders there, Kale Street Partners and Farallon Capital, provided $985 million of debt for the property at 80 Clark Street. The developers there, Atlas, along with Zeckendorf and Baupost. So amazing there. So a lot of real intrepid investors right now.
Yeah, I think, Manis, of the stories that you mentioned, the RXR one is the most interesting. There are mixed feelings on how easy and how profitable it is to convert an obsolete office into multifamily. So I think that's one that's going to have a lot of eyes on it to see if it really pans out the way that they hope.
Absolutely.
And so let's shift to who's buying and selling. We've got industrial, office, more industrial.
Yes, normally I like to bucket these by property type, but this might just come out as more of a litany because I didn't really organize my thoughts as well as I would have liked to. So without further ado, here goes. From Gabriel Frank of Commercial Property Executive, Brookfield has acquired another 15 million square feet of light industrial properties. These span Atlanta, Houston, and Dallas. The property sold for $1.3 billion. In the office space, this is from Mark Hallam of the Commercial Observer. JP Morgan is in contract to buy 250 Park Avenue, which is really right down the block from the Helmsley building that we just talked about. The price tag is said to be $300 million. The sale is not inked yet, but here that property is right next to the massive new property that JP Morgan is building for its headquarters. That property has been underway for several years right now. So apparently either JP Morgan needs the overflow or that massive property right above Grand Central is just not big enough. A bright spot from Ben Peters of the Washington Business Journal. Tishman Speyer sold 2000 K Street Northwest for $140 million. The buyer there, Spear Street Capital. Why do I call this a bright spot? Tishman bought the property 7 or 8 years ago for $89 million. So a nice uptick in the value, but that doesn't tell the whole story. They pumped $65 million into the property. So this is ultimately a net loss for Tishman, but the net loss is only about 10% of the value that they pumped into this thing. So any 10% loss in the office space right now is pretty good.
Sticking with industrial, we saw that it continues to be a sector that's in high demand, and we saw a couple of stories that proved that point.
Yeah, I think there was one coming out of Minneapolis this week that I thought was interesting. There's another growing driver for demand, and that's office tenants. Even as the flight to higher quality offices driving demand for these flashy kind of high-rise buildings, companies are starting to look for office space in those no-frills kind of industrial buildings known as flex tech. So I think that's an interesting trend to watch and one that maybe folks didn't really expect.
And we saw Prologis, the largest industrial landlord, has significantly increased the amount it plans to spend on acquisitions this year. They say they plan to spend about $1 to $1.5 billion this year to acquire properties, which is higher than their previous projection. They said that in their earnings report this Wednesday. So it looks like they believe transaction volume is about to heat up.
Between Prologis and the Brookfield story, there seems to be no industrial purchase fatigue whatsoever. This industrial wave is now on its 5th year, and values just keep going up. Activity keeps going up. Buyers just continue to pour money into the segment. I have been wondering, when would this trade get tired? And it seems to have no signs whatsoever of industrial fatigue just yet.
A big multifamily deal in Jersey City, my neck of the woods, sort of.
Yes. In fact, we saw a lot of sales come in the last 12 to 15 hours. I have a couple of them that I'll run through in very short order. Here, a $221 million sale by JP Morgan Asset Manager to Hines. This is 2 properties in Jersey City, totaling 408 units. So the sales price exceeds $500,000 per unit. A real positive sale there. It's the largest sale in New Jersey, actually, not just Jersey City, in nearly 5 years. CBRE's team of Jeff Dunn and Stuart McKenzie, Eric Apfel, Travis Langer, and Daniel Blumenkrantz worked on that particular sale. In New York, One Hotel Central Park at 1414 Avenue of the Americas sold for $233 million. This sale was done by Starwood Capital to Host Hotels. Why did this jump out at me? It jumped out at me because the sale price tops $1 million per key. People might remember that during the depths of COVID, we were seeing properties that once went for $600,000 or $700,000 per key, trading for under $300,000 per key. So this was a real nice sale for us. And then in Boston, AVA Theater District, this is apartments, sold for $212 million, $530K per unit. The seller there was Avalon Bay and the buyer was Carmel Partners. So As we mentioned last week, 9-figure sales happening a dozen, 2 dozen per week, and that was the case again this week. And by the way, if you do have a sale that we didn't talk about that you'd love us to talk about, either because it's interesting, because of its size, because of its uniqueness, its creativeness, by all means, reach out to us and we'd love to talk about it.
And you saw the news this week, the Mirage in Vegas closed its doors. So, Manus, I think a hot commodity we can offer as a giveaway might be Mirage beach towels, mugs, and other tchotchkes since the volcano is no longer.
I was at the Mirage several times. They had that Beatles throwback show. It is a very dated hotel. It was in need of an upgrade. I guess it's going to become a Hard Rock. Is that right?
Yeah, construction begins this fall.
So I'm trying to think, what might I bid on? I mean, there's nothing I would bid on because my wife has made it clear to me that we are in downsizing mode, not upsizing mode these days. We are not looking to add more tchotchkes or other bric-a-brac. But I'm thinking, what among their things might I grab? Would it be like a blackjack table? Would my wife let me put that in our living room and host nightly games with my neighbors? I don't know. I'd have to think about what would be the most creative thing I could both get away with and would be of interest to me. I'm not really sure. I have to give this a little bit more thought.
I want to see you in a Mirage chat on our next podcast.
Oh my gosh. Watch the deliveries come in.
There we go. A Mirage hat.
That wraps up this week's podcast. Thanks to our producer, Hannah Tebow. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send us your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.